Hello everyone. Good morning, good afternoon, good evening, depending upon when you are watching this video lecture. After the first chapter in business economics related to CA foundation syllabus, let us move on to the chapter 2 in this particular paper. So chapter 2 is about the theory of demand and the theory of supply and also the theory of consumer behavior. So broadly, this chapter 2 will focus on these three items: theory of demand in unit 1, theory of consumer behavior in unit 2, and theory of supply in unit 3. However, all of them are interrelated with one another. If we understand the theory of demand properly with the scientific explanations of how it works, then we can automatically apply similar principles to the theory of supply, but just on an opposite way. So a lot of times it so happens that we don't need to know in the same vigor, with the same intensity, all the things. For example, in chapter 1, unit 2, when we discussed about capitalism, socialism, and mixed economy, if we understand properly what is capitalism, then socialism automatically is understood, because the opposite of capitalism is socialism. So once you know one, the other one automatically reveals itself. And mixed economy, there is nothing special about it. Just mix both the concepts of capitalism and socialism, you will get it. So no special attention is required, no additional effort is required. It becomes relatively easier to understand certain things which will come later, but only when condition is first we should understand the core thing in a very detailed manner. That's what we did in the chapter 1 also. We tried to understand the characteristics, advantages, disadvantages of capitalism in a detailed manner. Once we understand that, just flip them, automatically you will understand the characteristics, advantages and disadvantages of socialism also. So similarly, in this chapter also, if we understand the theory of demand properly, more or less, we will be able to understand the theory of supply also, but just once again in a reverse manner. Theory of demand is from a consumption point of view, from a consumer point of view, whereas theory of supply is from a producer's point of view or a manufacturer's point of view. That's all, both on the opposite side. But the logic, if we understand the calculations part, for example, related to elasticity of demand and all, the words which are used here in the theory of demand, if we understand in detail, then the theory of supply relatively becomes easier to understand. Of course, the theory of consumer behavior is altogether a different concept, which will also be there as part of this chapter 2 in unit 2 of this chapter. However, on a broader basis, this chapter focuses on demand and what are the determinants of both demand as well as supply. For everything where there is a demand, there is a supply also. And when there is law of demand, of course, there is a law of supply also, automatically. So, and what are the various things, like we have demand schedule and demand curve. Naturally, we will have a supply schedule and supply curve. Opposite. Once again, expansion and contraction of demand, increase or decrease in demand. Same way, expansion and contraction of supply, increase or decrease in supply. How to identify them both? So just replace demand with supply. Every theory of whatever we learn in demand also has a similar thing in supply also, which we will come later. So as part of unit 1 of this chapter 2, we will focus more on the demand first. Same things will be applied later in supply also. Same way we have elasticity of demand. Elasticity of demand requires a little bit of calculations also. Of course, there is a elasticity of supply also, which we'll have to calculate later. So every aspect, if you observe, whatever is there in the demand, all of them have a counterpart in supply also. Same things we have: determinants, law of demand, law of supply. Demand schedule, demand curve, supply schedule, supply curve. Elasticity of demand, elasticity of supply. Expansion, contraction of demand, increase or decrease in demand. Expansion, contraction of supply, increase or decrease in supply. So what is the difference here? Yes, there is opposite difference here, no doubt about it. All are not same, but the concepts that we are going to use are same. That is why the understanding has to be at a conceptual level. If we understand one's concept, that can be easily applied to another concept. That's what will happen later when we come to the topic of supply. But before that, the theory of demand, the first unit of this chapter number 2 will focus on these items in relation to the law of demand, demand schedule, demand curve, elasticity of demand. Even elasticity of demand also has different types of elasticity. There is price elasticity, there is income elasticity, there is cross elasticity, like that, advertisement elasticity. So many types of elasticity of demand we can study in this particular unit 1 of chapter 2 related to the demand. So our focus area here is going to be the demand and all the things that are going to be related to the demand. So these are all the things we are talking about in this particular chapter. So demand is our focal area. We can consider this. This is the focus area to start with. All the things. Determinants, law of demand, demand schedule, demand curve, elasticity of demand, different types, expansion, contraction of demand, increase or decrease in demand. So this area is all about the first unit of chapter 2. Of course, there is another concept of demand forecasting, but as I told already in the introduction, demand forecasting we are not going to do, but we are going to understand there is something called demand forecasting and some techniques are used for demand forecasting. We will come to know that there are techniques used, but we are not going to use any techniques. This proper demand forecasting application of statistical techniques will happen not at this level. Practically speaking, at final level you will be able to apply them. Here we will only know that okay, there is something called demand forecasting. Forecasting is about budgeting and that uses certain types of statistical and mathematical tools and techniques. That's it. That's what we will do here in this unit 1 of chapter 2. Unit 2 of chapter 2 will focus more on this theory of consumer behavior, which will have broadly two things only. That is unit 2 of chapter 2, which will have theory of consumer behavior, which have two types of theories on a broader basis. One is marginal utility analysis, second one is indifference curve analysis. With these two theories, unit 2 of chapter 2 will be done. And the unit 3 of chapter 3 obviously is about supply. And what are the supply areas? Supply of course includes the determinants of supply, then everything else like the law of supply, supply schedule, everything. And not only that, including the elasticity of supply. So these all areas will be covered in unit 3 of this chapter 2. So supply, determinants of supply, law of supply, supply schedule, supply curve, expansion and contraction of supply, increase or decrease in supply, elasticity of supply. Those are will be unit 3 of chapter 2. So in a nutshell, this chapter 2 has 3 units and these are going to be the overall contents of this chapter, which is mentioned in chapter overview. So 3 units, one is the demand, one is consumer behavior and the other one is supply. Let us start with the demand. Basically, the first unit of chapter 2 starts with the theory of demand and the word demand. What does it mean and what is the meaning of demand? What are the definitions of demand? Also, how demand is affected by different types of factors. All those things will be discussed in this first unit of chapter 2. Now there is one kind of situation that is given, a hypothetical situation. I think you can just generally go through that. There is all just a story. There is nothing technical to discuss about it. But one point here, definitely what is going to happen here is, so there are various things that are going to be important factors when we talk about a market mechanism. So the market system is determined and governed by the market mechanism where the price of a commodity or service is determined by the forces of demand and supply. This is what we already know because what mechanism we are talking about is market mechanism, because what system we are talking about is market system, or we can also call that as capitalist system. In a capitalist economy or a market economy, market mechanism or price mechanism is that where the price of a commodity or service is determined by the forces of demand and supply. That is why we should be knowing both of them. Only demand is not enough, only supply is not enough. Of course, what is demand? That is the buyers who will constitute the demand side of the market. Seller make the supply side of the market. That is very simple. That's what we are talking about here. Demand is all about consumers or customers. Supply is about producers, sellers, manufacturers. We can call whatever the names. So buyer side or buy side is about demand, seller side or sell side is about supply, but both put together will have impact on the prices of the commodities in any market economy. So definitely, what are the various factors that will influence the demand and supply will become very important to understand the market mechanism, will become very important to understand the capitalist system or market system, which normally is what our discussion area is going to be. So that is why demand plays a very crucial role in many items for the organizations. So that is the reason we need to understand what is demand and what are the factors which will influence demand. Now, let us understand the concept of demand first, or meaning of demand. Definitions you can call them. Whatever it is, number of ways it can be expressed. But once again, what is expressed, how is it expressed, matters only a partial way. But what matters more is, do we understand the concept of it or not? Are we able to grasp the meaning of the demand or not? That matters a lot. So let us understand the concept of demand. So what is the concept of demand? Demand basically is the quantity. When we say demand, we are talking about not in general rupee terms or monetary terms. We are talking about quantity terms, quantitative terms of what? Of a good or service. So quantity of a good or service. That is again English language problem. So you have to observe that it is not good, good, bad, good, not that good. This is GOOD, good. Good also GOOD, good also GOOD. So this is not good, this is good. Goods and service tax. In that, whatever good is there, that good this is. So the quantity of a particular good, you can call that commodity also, that is easier. A commodity or a service that the consumers are willing, very important point is willing, not only willing, but able to purchase also. So there is a good or service that consumers are willing, but not just willing, they are able to purchase also at various prices during a given period of time. So all these things are there part of the concept of demand in a nutshell. So first of all, when we say demand, we are talking about quantity, not money. We are talking about quantity of what? Of any particular good, commodity or service which the consumers are willing to buy, and not only buy, they are not only just willing to buy, they are able to buy. Why these two factors will become important? Imagine if there is willingness but there is no ability, then that does not constitute demand. Or other side, imagine there is ability but there is no willingness, then also it will not constitute demand. Both should be there, willingness should be there, ability to buy also should be there. When both are there, then we can say yes, there is a demand for that product. And what that demand is expressed as, it is expressed as a quantity of a particular good or service, and that quantity also will not be constant, that will be changing at different prices. So what quantity is demanded at which price, that has to be expressed. So whatever the quantity of good or service that consumers are willing to and able to purchase at various prices, that to not just infinitely during a given period of time. So each and every word is important here. During a given period of time only we can express it. If you say that the demand for cement is 50,000 tons, that doesn't make any sense. Why? Demand for cement is 50,000 tons. Okay, sir. First of all, where? Is it demand for cement 50,000 tons in Telangana, in Orissa, in India, in America, in Australia, in Zimbabwe? Where is that? That first of all is required information. If not, that doesn't make sense. Okay, forget about it. Let us talk about only, let us say, India as a basis. Normally we express everything for that. So demand for cement is 50,000 tons. Okay, fine. in India. Fine. That also is ridiculous. Why? Okay, sir, 50,000 tons demand is okay, but what is the period of time you're talking about? Are you talking about daily demand? Or are you talking about weekly demand of India? Or is it monthly? Or is it quarterly? Or is it half yearly? Or is it annual demand? What are you talking? Which one we are talking about as demand? The quantity we mentioned 50,000 tons. Very good. Product is cement. Very good. The consumers definitely are willing to buy and able to buy also. Then only there is a possibility of production and sale of that particular commodity. All these things are known. But if you don't express with reference to a particular period of time, again, that will not be appropriate expression for demand. So demand is first of all expressed as a quantity, that is one point. Second, it should be expressed for a particular period of time at different prices. So there is a three-layered approach here for understanding this. Of course, the common points in this are very simple. Of course, there is a good and service, then only we are talking about a demand. And not only that, the consumers have the ability to purchase that good or service and willingness to purchase that good or service. Both are there, then only we are talking about it. Once we know that there is a good or service, there are consumers, there is willingness, there is ability. All these things are there. Once these things are all there, what are the three aspects which will become very important for the demand? First and foremost aspect of expression for demand is that it is expressed in quantitative terms. So demand is about a quantity. That is first thing. Second thing is that it is not going to be same at all prices. So this quantity changes according to the prices. So quantity is one thing, price is another thing, and not only that, it is expressed for a particular period of time. So these three aspects will become very important for understanding the concept of demand. Demand is about quantity of a good or service which is purchased at different prices during a particular period of time, during a given period of time. Then only we call that as demand. So without the expression of price and time period, the expression of quantity as a demand has no meaning. That's what we have to understand. Okay, that is the first point which will tell us the concept of demand. All of the other points are very natural. For example, willingness. Yes, of course, willingness is required. Without willingness, ability is not going to constitute demand. But is willingness enough? No. Ability also is required. Let us say if a beggar wants to buy food, he might have a lot of willingness actually to buy food, but if he doesn't have the ability to buy, there is no demand created by that beggar. So effectively, demand depends upon what? The effective demand for a thing depends upon desire, means to purchase it, and willingness to use those means for that purchase. All three should be there. Means all should be at same time. Same time they should be there. Desire is there, but means to purchase are not there. Means to purchase generally is money. How will you purchase something? Money. So desire is just a feeling. Means to purchase is money. Both should be there. And willingness to use that means for that purchase also should be there. They should be matched. That willingness should be also there. A lot of times it so happens there will be desire also, there will be means to purchase also, but still people will not match them because they don't have that willingness. For various purposes, people may not spend the money for all the desires that they have. Sometimes people might save that money for fulfilling something that future may present to us. So demand in the market is created for the commodities and goods or services only when all the three are put together at the same time existing. There should be a desire to purchase. Second, there should be ability to purchase, and there should be willingness to use that particular ability, which is money, to satisfy the desire. Then only this demand is created. So the point again to note here, which is a casual, normal point, nothing rocket science in that, but simply that is an important point. That is why we have to be very careful about it. Unless the desire is backed by the purchasing power or ability to pay or willingness to pay, it does not constitute demand. Simply, demand will come into picture only when ability plus the desire both are there at the same time. Timing is also important. Today ability is there but desire is not there. Let us say tomorrow desire is there but ability is not there. Still it does not constitute demand. Both should be combined at the same time. Then only there is a possibility of demand being created in the market. So the same thing we are talking about here. The three major aspects of demand are: one is quantity as an expression at different prices during a particular point of time. Point of time here is not a point of time, it is a period of time. A day, a month, a week, whatever it is, whatever it could be. But there should be a specification of a period of time in which the quantity demanded will have to be expressed at different prices of a particular product. Then we can call that as an expression of demand. So first point to be noted here is the word used here is more or less quantity demanded. So there are two things here. We'll note them very clearly. There is a difference between quantity demanded and demand. So quantity demanded is a different phrase. Demand itself is a different phrase. Though demand also is an expression in quantity, both need not be same. What is the difference? We will definitely come to know in the coming sessions when we understand the theory of demand in detail. But point to note now is very important point. Very important point now is when we say quantity demanded, that is telling us a different story, that is something which is different. And when we just use the word demand, that is different. Both are not necessarily same. Those two are different expressions. That we should know. What is the difference? We will definitely come to know in the next classes. But what are the things to be noted about the quantity demanded? That's what we are talking about. Always it is about a given price. That's what we are talking here. That is a point here. So the quantity is always expressed at a given price. So which means what? When the price changes, also automatically the quantity demanded changes. Both are not going to be remaining constant. When price is changing, quantity demanded also changes along with that. How it will change? Of course, that is what is demand theory. That's what we are going to discuss as part of the law of demand. But one thing for sure, quantity demanded is not a standalone function. It is dependent on the price of the commodity, and these two are related with each other. That is for sure. That's what we are talking about in the first point. So the quantity demanded is always expressed at a given price, and at different prices, different quantities of the commodity are generally demanded. So as the price changes, quantity demanded also changes. That is one point to note. And second point, that is what we are talking about here, that is a T, that is time. Quantity demanded is a flow concept. Flow happens particularly when you have 2 points. So that is what we call about period of time. See, time is also something which is never a stagnated thing. Can time stop? Can be stopped? Is it possible at all? You may say that I will remove the battery in the clock and it will stop. Clock is stopped. Time is not stopped, sir. So clock can be stopped. Time cannot be stopped. Time is a flow. So definitely if you want to express something related to time, you need to have 2 points. Between this, we call that some name. We give that some name. So we can call that the time period between these 2 points as a day. If it is like a 24 hours period, we can call this as a week, or we can call this as a month if the time period is 28, 29, 30 or 31 days according to the month and year. So similarly, when there are 2 points, between these 2 points, whatever the period is there, that's what we call as time period. So time is a flow concept. Demand is also a flow concept. So any time when we express the demand, this demand is always expressed for a particular period of time. That is what we are talking about. Same thing as we discussed earlier. When you say quantity demanded, it has to be expressed at a particular price. Why? Because if price changes, demand also changes. The quantity demanded also changes. Same way it has to be expressed for a particular period of time. Period of time. There is a difference between period of time and point of time. Point of time is only just a point concept, whereas period of time is a flow concept. So we are not talking about a single purchase or one particular purchase. We are talking about a flow of purchases. So how much demand has to be expressed, like how much what? So much per the period of time always has to be expressed like that. Per period of time means what? So much per period of time means, like let us say for example, just for understanding purposes, so much per period of time means, so let us do this is easier. So we're talking about per period of time. So per period of time means what? Per day, per week, per month, like that. So per period of time is an expression for demand always. So the time period matters while we express the demand. So for example, like example it is given. So 1000 dozens of oranges, let us say, is the demand. Okay, fine. 1000 dozens of oranges per what? Per day. That like that it has to be told very clearly. Let us say 7000 dozens of oranges is the demand if somebody says. Per what? Per week. Like that it has to be expressed in relation to a time period. Why is that? Because the quantity demanded is a flow concept, not a stock concept. There are always opposite concepts we should know. Some of them we discussed earlier already in some of the classes. For example, what we discussed about this stock concept and flow concept just now. Stock concept means at a particular point of time. Flow concept means that is a period of time. So stock concept is different, flow concept is different. Objectivity, subjectivity, something else we discussed earlier. Abstract, concrete, something else we discussed earlier. Like positive, normative, something else we discussed earlier. So any time when we have absolute things and relative things. Absolute means which is exactly whatever the fact is. Relative means incomparable with something else. So a lot of expressions will be there which are used particularly in a technical subject like economics. We should be aware of these words and meanings of them. So what is the quantity demanded? Which type of concept it is? It is not a stock concept. It is a flow concept. Stock concept will be at a particular point of time. Flow concept will be for a particular period of time. For your general understanding, so that you can easily understand, balance sheet is a stock concept. Why? Because balance sheet is prepared on a particular date. On a date it is prepared. But whereas P&L account is a flow concept. Why? Because it is prepared for a period of time. That is why if you remember the headings of balance sheet, the balance sheet heading will be what? Balance sheet as on a particular date, as on so and so date. It is on that date only. The position of the company before that date is not the same, after that date is not the same, it has changed. But the position of the company, financial position of the company on the date of balance sheet is how much? That is expressed by the balance sheet. So balance sheet is telling us the position of a company on a particular date. So it is a stock concept, not a flow concept. Profit or loss account, profit and loss account is telling us the profit or loss related to not on a date. It is related to a period, for a year or for a quarter, for a half year, like that. The profit and loss account is giving us the financial performance related data for a period of time. So that is a flow concept. So this difference is there. So when we talk about demand or quantity demanded, to be precise, quantity demanded is what type of concept? It is a flow concept that we should remember. So the 2 points here we have to be very clear. One, the quantity demanded always has price in its nature. So price has to be there as part of its one of the areas. So price is one thing, and another area that is to be understood is time period. Same thing as we talked about. So quantity demanded is always expressed at a particular price for a particular period of time. That is what about demand concept is all about. Now, in simple words or otherwise, basically what is the demand? We can just define as is this. What is the demand? It means the various quantities of a given commodity or service which the consumers would buy in one market. Again, place also matters here, because without referring to the place, it doesn't make sense. Okay, fine. We are talking about this 1000 dozens of oranges per day. Okay, sir, but where? Is it like 1000 dozens in one area or one street or one locality or one town or one city or one district or state or country or entire world is using only 1000 dozens of oranges per day? No, we don't know that. So without mentioning the place or market, that also becomes a irrelevant expression. So one market, that is also an important aspect. So by demand we mean the various quantities of a given commodity. First point is we are talking about various quantities of a given commodity. Quantities of given commodity or service which the consumers would buy in one market. One market. So that is a place we are talking about during a given period of time. So we are talking about a period of time at various prices. So we are talking about different prices, or at various incomes. We will see that also, how incomes will have an impact, or at various prices of related goods. Prices of related goods. So all of them will simply be expressed as demand. So there are two things here. Now, because the topic has come, it is easier to understand. Every time, whenever we are going to use the word quantity demanded, we are going to understand the relationship between quantity demanded and price. So, when the price is the factor which is impacting, then we use the word quantity demanded. So, the price is impacting what? The price is impacting the quantity which is demanded. And what about others? There are many other factors we are talking. Incomes are affecting demand. Let us say prices of related goods are affecting demand. They are not impacting quantity demanded. They are impacting demand. Both are quantities only, but the expression is different. So be very clear on that in the questions also in the examination. When the word quantity demanded is used, what are we referring to? The change in the quantity demanded is happening in accordance to the changes in prices. When he says there is a change in demand, what does it mean? Change in demand is happening according to the changes in something else other than prices. What could be that? Many factors actually. Only two are mentioned here. One is like incomes of the consumers, or the price of related goods, etc., etc. There are so many factors which will have an impact on demand. However, common point always to be noted is demand is an expression in the form of a quantity at a particular time period or during a particular time period at different prices. That's what we call as quantity demanded. And when there is a change in demand, we are using the word that refers to the changes in the overall quantity of the demand due to the changes in incomes of the consumers, or prices of related goods, or some other factors which might be there, which will impact the overall demand. So this is what is going to be the basic chart, we can say the diagram, which will tell us what are going to be the determinants of the demand. What determinants of demand are there, or you can say the factors which are affecting the demand, or you can say the influencers of demand. What factors will influence the demand, or you can even call that in another way, demand is influenced by which kind of factors. Either way, all the ways ultimately meaning the same thing. What are they meaning about? They are talking about the determinants of the demand. So how the demand is going to change when any of these factors is going to change. Will there be any impact on the demand due to any of these factors? Of course, yes. That is why we are talking about all of them as determinants of demand. What are all those determinants of demand? Three things we already touched. One is price of the commodity itself, one is price of the related commodities, another one is income of the consumers. All the three are just mentioned in this definition also. So these three are already just as namesake, we know them. Price of the commodity will have an impact on demand or not? Yes. Prices of related commodities will have an impact or not? Yes, of course. And then the income of the consumers will have an impact on the demand or not? Yes. All these three will have definitely impact on the demand. But these three are quantifiable things. So let us understand what is the common point in these three things. Price is a number. Price of related commodities is also a number. Income of consumers also is a number. So these three things can be expressed as a number. That is one common point between all these three things. That is for sure. So the common point between them is these three things particularly is that these are all possible to be expressed as some number. Number, definitely yes. Number may not be representing the same. Price may be expressed in rupees. Income is expressed in rupees. Price of related commodities is expressed in rupees. So all of them are numbers in the sense of money terms. They are all expressed. All of them are expressed in money terms. Say for example, rupee terms. Right? So that is going to be the expression of all these things. So when you have this expression of all these things in rupee terms particularly, the quantity demanded is not rupee terms, that is in number of units like kilos, liters, tons, meters, so depending upon the product. Let us say cloth. Cloth could be expressed as meters. Let us say petrol could be expressed as gallons or liters or drums. So the different quantities can be there for quantity demanded, but that is not rupees, that is quantity. And these factors which are influencing that quantity demanded or the demand are three things. One is the price of the commodity itself, two is price of the related commodities, and three is the income of consumers. But one common point among all of them is they are all quantifiable. They can be expressed as some number. What is the price of commodity? 40 rupees. Number. What is the price of a related commodity? 28 rupees. Number. What is the income of the consumer per month on an average? 4,000 rupees. Number. So all these three are quantifiable. But look at the other things like consumer expectations or consumer tastes and preferences. These two things we can say are not quantifiable. These two are not quantifiable. If I ask you a question, do you like Coca-Cola? Some of you may say yes, some of you may say no. Both will be there. There cannot be only one category of people. So taste and preference of consumers will be different. That need not be same. Then I will ask another question. Let us say somebody says, yes, I like Coca-Cola. If I ask a second question, how much you like? How much? Can you quantify? Can you say that you like 200 ml, you like 400 ml, you like 2 liters, you like 100 liters? So can you drink 100 liters of Coca-Cola if I give you immediately? Not possible. So the point is, there is no quantification for liking or disliking. Somebody may say, I like, I dislike, but it is very difficult to quantify that. Those are qualitative things. That is the difference. So the first three items, price of the commodity, price of related commodities, and income of consumers, these three are quantifiable items, whereas consumer expectations, tastes, and preferences are not quantifiable. Those are qualitative items. But both qualitative and quantitative items will have an impact on demand. That is what we should understand. So demand is not influenced only by the quantitative factors. It is also influenced by qualitative factors. That's what makes it a complex point in reality to identify how the demand is changing. That is a different story. We will come to each of these topics separately. But now we should understand, yes, there are qualitative as well as quantitative factors which will have an impact on demand. And then there can be other factors always. So what other factors? Hundreds of factors can be there. We don't have to think about all of them. Few factors we can have an example of. But ultimately, what major factors will have an influence or an impact on demand will be these. One, price of the commodity. Two, prices of the related commodities. Three, income of the consumers. All the three are quantitative, quantifiable, expressible in the rupee terms or money terms. Whereas consumer expectations, tastes, and preferences definitely are not quantifiable. Those are qualitative things. So they will also have an impact on demand, but we can only sense a direction, but we cannot really find out the quantification of that. Tastes and preferences of the consumers is so favorable for jeans, pants, let us say. That is okay. That can be a true statement. But the question comes, how much favorable? That is a difficult question to answer. So that is where the qualitative aspects will have impact on demand, but difficult to quantify them, difficult to gauge them, difficult to assess the real impact of them on the demand. However, we can know the direction, definitely yes. People are liking this. We can understand that tendency. As a trend, we can understand. People are not liking this. As a trend, we can understand. But how much they are liking, how much they are not liking, that is difficult to quantify. There is always a counter argument for the statistics which might be available for tastes and preferences of consumers. Of course, I'm not telling they are not at all quantifiable. There are marketing agencies who do surveys for that. There are people who will take ratings. Why are you giving ratings every time when you get a delivery of any Swiggy or Amazon or something? Because that is also a methodology of quantifying the satisfaction. Normally, satisfaction is something which cannot be quantified, which can only be felt, which cannot be expressed in general. But somehow they try to quantify. 5-star means okay, you are very happy. 4-star means okay, but not that happy, like that. So quantification is difficult, not impossible, but difficult. Not scientific also in 100% of the cases. So a lot of times it so happens that fake surveys can be there, fake ratings can be there. Sometimes people will have all techniques used for their fake reports, and we see that everywhere. A lot of times we can see such type of situations. Okay, common public cannot understand, but those who understand general tendency of a particular business and a particular organization, they will be able to understand that. But the point is, quantitative things are easier to capture, qualitative things are difficult to capture, but some efforts will be taken. to capture the data from them also. But once again, is it our job to do that? Absolutely not. That is the job of the people who are in the business of market surveys. Huge companies are involved in that. There will be people working for them, doing the donkey job of collecting lot of data and processing that. But that is not our business. Our job here is to know that there are certain things which will have an impact on demand which could not be quantified immediately, like consumer expectations, tastes, and preferences of consumers. Both of them are feelings. They are subjective, not objective. They are not realities. That is the feelings. Consumer expectations always need not be correct. Consumers foolishly can expect that the price of a particular commodity might increase after the budget. But actually, after the budget, the price of the commodity may decrease. So, what happened to consumer expectations? Gone for toss. So, expectations are expectations. That is only a judgment. That is only a feeling or a thought or an opinion, not necessarily the reality. Reality could be something else. Taste and preferences also is a feeling, it's an opinion, it's a judgment. The reality is different. So if people are liking, that does not mean it is really good. People are liking, people are liking. That is only expressing a taste or preference of the consumers, nothing else. So these two things are qualitative items. All the other three are quantitative items. Other factors anyway can be there, which also can have an impact on the demand or quantity demanded. That is the main point here to note when we talk about the demand theory. So we are entering into some of the areas where the demand theory also talks about these factors and how they will have an influence on the demand. Let us start with the factors one by one. So the first and foremost factor and the most important factor also is basically the price of the commodity. Price of the commodity, does it have an impact on the demand or not? Absolutely yes. Now what is our requirement here? We need to understand how that will have an impact on the demand of the commodity. How means what is the direction in which it will have an impact. So that is what we have to see. Look at this Latin phrase that is used, ceteris paribus. Ceteris paribus is some of the things that lot of times it will be used, and because you don't have a descriptive examination, you cannot use it in exam. But in the exam, in the questions, it can be used. So what does it mean? Ceteris paribus means all the other things being equal. Means when all the other things are not changing, all the other things being equal without any change in the other factors, usually how the demand and the price are related. Very important. The demand for a commodity is inversely related to its price. That's it. The demand for a commodity is inversely related to its price. That is the crux of this particular aspect, that is price of the commodity. So the price of the commodity, how it has an impact on demand? By having this, the demand for a commodity is inversely related to its price. Means when the price of the commodity increases, demand for that commodity decreases. When the price of the commodity decreases, demand for that commodity increases. That's what happens in case of price of a commodity having a change, which will impact the quantity demanded in a inverse way. So the main point here is the relationship between these two items is inverse relationship, not a direct relationship. And that relationship is between what? Price of a commodity and quantity demanded. That's what is mentioned. For example, if there is a rise in the price of the commodity, if at all, then naturally what happens? That will bring out a fall in the quantity purchased and vice versa. If there is a fall in the price of the commodity, there will be a rise in the quantity purchased or demanded. Why is that? Because of various things. We will discuss that. This entire thing is the law of demand. So the law of demand itself is about what is the relationship between price of the commodity and quantity demanded. So we will discuss that as part of the law of demand in the same chapter, in the same unit also. We'll come to that later. But basically, the essence of that can be understood. What is the essence of the law of demand? That we already know. When the price of the commodity increases, when the price of the commodity increases, what happens to the quantity demanded? Quantity demanded will decrease. Quantity demanded will decrease. On the other side, when the price of the commodity decreases, if this decreases, then what happens to the quantity demanded? Quantity demanded will increase. That's it. This is what is law of demand, theory of demand. The great theory of demand is all about this nutshell. Price increasing, quantity demanded decreasing. Price decreasing, quantity demanded increasing. That is the first factor, price of the commodity. Now coming to the second thing, that is the prices of related commodities. See, related commodities is a big discussion separately by itself. Of course, we have that also as part of understanding the cross elasticity of demand. Later we will come to that. However, before going to that level of understanding elasticity of demand, we should understand first of all what is the relationship between the price of the related commodities and the quantity demanded of original commodity. So always we have to understand here, in the first case, what is increasing or decreasing is the price of the same commodity, quantity demanded of same commodity. Whereas when we are talking about the prices of related commodities, price increasing or decreasing related to what? Not of the same commodity. That is in relation to some other commodity. So this top portion is related to some other commodity. Quantity demanded is related to some other commodity. So what is our original commodity here we are talking about? That is this portion. What is the related commodity? That is this portion, the top portion. So the top portion is talking about the prices of related commodities. What happens to the quantity demanded of the same commodity, original commodity, what we are talking about. So that's what we have to observe here. Of course, the relationship will not be same. It will be opposite. We have to observe that. But before that, we need to understand what are related commodities. Related commodities are of two types. First category can be called as complementary goods. Second category can be called as competing goods or sometimes called substitutes. In simple words, substitutes and complementary goods are called as related commodities. These are related commodities. What is the difference between them? Nature of them we have to understand clearly. Then only we can understand how they will impact or their price will impact on the quantity demanded of or the demand of the original commodity. So we are talking about two things here. Always we will refer like this. We are talking about related commodity. One is that whatever it could be. Related commodity could be again two types. One is substitute and second one is complementary. Both are possible. But in any way we call that as related commodity. And other thing what we are talking about as is original commodity. Original commodity is our commodity that is original. So what related commodities prices changes, demand of original commodity also changes. Question is how it changes is the point. So that changes depending upon whether this related commodity is a substitute or complementary. For that to understand, we should understand first of all what is complementary and what is substitutes. What are complementary goods? Those are the ones which are consumed together or simultaneously. Those can be called as complementary commodities. They are consumed together or simultaneously. For example, we can say tea and sugar. They can be considered as complementary commodities because both are consumed simultaneously. You can say some people will have diabetes, they will not have sugar and all. So those exceptions are not what stupid things we are going to discuss here. So we are talking about normal things. Normally, tea and sugar are consumed together. So if, for example, just for understanding purposes, the price of the tea has increased, then what happens? First of all, when the price of the tea has increased, the demand for tea will decrease. That we know because of the theory of demand. When the demand for tea is decreased, demand for sugar also will decrease because tea and sugar are what type of commodities? Complementary commodities. So the demand for tea and demand for sugar go in same direction. If demand for tea increases, demand for sugar also increases. If demand for tea decreases, demand for sugar also decreases. Why? Because they are complementary to each other. Same way petrol and automobile. Let us say more and more automobiles are purchased by the people. Naturally, what happens? The demand for petrol also increases. Less automobiles are purchased by the people. Demand for petrol also decreases. Pen and ink is an old example. Nowadays, nobody is using ink pen. But still, it can be also another example for understanding what is a complementary goods which are consumed together or simultaneously. That can be called as complementary commodities. Nowadays, best example can be considered as a printer and its cartridge. So, printer and cartridge are related to each other. Once more printers are purchased, along with that, naturally the cartridges also will be purchased and increased. So naturally those are all related commodities with each other. They are consumed together. Or for your technology generation, we can say that, let us say, mobile phones and selfie sticks. So selfie sticks separately will not have much of the demand. They will have a related demand with the mobile phones. If mobile phones demand increases, along with that the selfie sticks demand also can be increased. Along with the mobile covers, different types of covers that people purchase, that will increase. It depends upon also the demand of mobile phones. Like this, any number of examples can be taken for sub complementary commodities. So when we talk about the complementary commodities, they are complementing each other, they are helping each other. Cartridge helps the printer to run. The selfie stick is possible to be operated only first of all when there is a mobile. So these two are related to each other. In the olden days when cameras were there, cameras and films, they are all complementary commodities. Once they are consumed simultaneously, tea and sugar is an example. Coffee and sugar also can be an example, no problem. Coffee and milk is an example. Both can be consumed together or simultaneously. Automobile and petrol, pen and ink, printer and cartridge, mobile phone and mobile covers, like that. Computers and computer software, all of them are complementary commodities. So computer software demand will increase when computers are demanded more. So naturally these two are consumed together or simultaneously, then we can call them in general the complementary goods. Such type of goods will go in the same line of direction, means they are not having opposite competition with each other. So if one increases, the demand for one increases, the demand for other also increases. How strongly it will increase, how strongly it may not increase is a different story, but definitely there is going to be a same directional increase in the demand of related commodity, which is a complementary commodity with original commodity. So when the demand for original commodity increases, complementary commodities demand also increases, and vice versa. Means what? When the demand for original commodity decreases, then the demand for complementary commodity also decreases. That's what happens here when we talk about complementary goods. Now let us understand how this works. Complementary goods. Complementary goods, with the same examples, any one of them we can take. Let us take tea and sugar, whatever example can be taken, but just we are taking an example of tea and sugar. So when we have this tea and sugar, these are the two types of commodities. Yes, okay, fine, we have two types of commodities. What happened here is, let us say the price of the tea has increased. Okay, what has increased? The price of the tea has increased. So when the price of the tea has increased, we are talking about price of the tea has increased. What happens to the quantity demanded or demand of sugar? Sugar demand will increase or decrease is the question. So first of all, we have to understand this sugar demand is not directly just, it is influenced by price of sugar only. It is of course influenced by price of sugar, but that is not what we are talking about. That was the first point. Now we are talking about the price of some other commodity has increased, which is a complementary commodity, which has an impact on the original commodity. So what is the original commodity here? First of all, that is sugar, and the complementary commodity is tea. So price of the tea has increased. What happens to the demand for sugar is the question. For that, we should not answer directly. That is where a lot of people do mistake. If you answer directly, possibility of doing a wrong answer, or otherwise unnecessarily by hurting things will come. Never do that. Understand it simply in a conceptual manner. Okay, sir, first of all, what happened? We have to go in a step-by-step process. This will not take that much time when you practice it again and again. See, price of the tea has increased. So what happens to the demand for tea? First of all, what happens to the demand for tea? When the demand for tea decreases naturally, and the price of the tea has increased, demand for tea will decrease. Now that is what first point is talking about. When the price of the commodity increases, demand for that will decrease. So naturally the demand for tea will decrease. Now you have to apply this here. Okay, then what happens to the sugar demand if the demand for tea decreases? Naturally sugar demand also will decrease. That's it. When the price of the tea is increasing, not only the demand for tea, but also the demand for sugar simultaneously is decreasing, because these two are complementary goods. That is what happens here. Naturally, when the price of the complementary commodity is increasing, other two, the original commodities demand also and complementary commodities demand also will decrease. Now take the opposite of this. Opposite will be opposite. What if the price of the tea has decreased? Or let us take this example which is given here. Let us say the price of the fountain pen has decreased, right? Price of the fountain pen has decreased, reverse of this. When price of the fountain pen has decreased, first of all you have to think about what happens to the demand for fountain pens. Demand for fountain pens will definitely increase. So naturally, with an increase in the demand for fountain pens, there will be a rise in the demand for ink also. So when the price of the fountain pens is falling, demand for ink is increasing. How is that possible? That is possible because these two are what type of goods? They are complementary goods. So complementary goods also will behave like original commodity. That's all. When the in the original commodity also this is the same, right? When price increases, quantity demanded decreases. Price decreases, quantity demanded increases. That's what happens in original commodity. The same thing happens for complementary commodity also. In the case of complementary commodity also, price of the complementary commodity increases, the quantity demanded or demand of the original commodity decreases, or price of the complementary commodity decreases, the demand for the original commodity increases. So once again, what is the relationship between the price of a complementary commodity with that of the demand of the original commodity? That is same as the original thing. That is what? Inverse relationship. That's it. So what we can call this as, conclude this as, there is an inverse relationship between the demand for a good and the price of its complement. This is what is the final conclusion of this entire paragraph by understanding the example of complementary commodities. Is that clear? Once again, there is an inverse relationship between the demand for a good and the price of its complement. Price of its complement increases, demand for the good decreases. Price of its complement decreases, demand for the good increases. Reverse, always. So that is how the price of the related commodities, particularly the complement commodity, will have an impact. Then on the other side, there could be substitutes also. Substitutes can also be sometimes called as competing commodities, competing goods. Means here, there is no direct relationship between these two commodities. If the demand for one commodity increases, the demand for other commodity decreases. They are not going in side by side because they are all replaceable by each other. In other words, they satisfy more or less the same want and they can be used in the place of each other. So examples only, once again, tea and coffee, example only. Practically, they are not substitutes. Those who drink tea cannot substitute with coffee and vice versa. But let us not go into those practicalities. Theoretically, at least we can have an example like, let us say, ink pen, ball pen. So if you use ink pen, you can substitute with that ball pen also, with the ball pen also, like that. So many different types of commodities can have substitution effect. That means what? Instead of one, there can be another commodity that can be used also. So when there is a possibility of a substitute, the commodities we are talking about original commodity and substitute. Original commodity and how this is related commodity is substitute. These two are competing with each other. That is the point we have to understand. In other words, they can be used in the place of one another easily. They can be used in the place of one another easily. That's what when we call them, the goods are substitutes. Now let us understand the, once again, demand and price relationship. So what are we talking about? We are talking about, let us say, substitute commodity, or let us take this example of tea and coffee, only example once again. Both are substitutes. So let us say what happens when the price of the tea is increased. When the price of the tea is increased, what happens to coffee is our interest. But once again, we should not directly go to coffee. First, what we should do? First, we should do, okay, sir, price of tea increased means the demand for tea happened what? Demand for tea definitely decreased, right? When the demand for tea decreased, demand for coffee will increase because people will replace the tea with coffee, right? So how is the relationship here between the price of the tea and demand of coffee? The relationship is direct. Both are going in same direction. Here earlier the relationship was inverse. So when the price of the complementary commodity was increasing, demand for original commodity was decreasing. Here when the price of the substitute increasing, demand for the original commodity also increases because the demand for substitute decreases, that will replace the demand for the original commodity. So that's what happens here. So what we can say here directly, final answer or final conclusion, what we can draw here is there is a direct or positive relation between the demand for a product and the price of its substitutes. When the price of the substitutes are increasing, demand for the original commodity also increases, and vice versa. Vice versa means if the price of the substitute decreases, then demand for the original commodity also decreases, because there is a direct relationship between these two. Which two? The demand for a product and the price of its substitute. So these are the two important things in the theory of demand. Out of all, these two are the most important things we can say. The relationship between the price of the commodity and the quantity demanded of itself. That is the first case. The second thing is the relationship between the price of a related commodity and the impact of that price change on the demand of the original commodity. And what is the conclusion we can draw here? This is a very important conclusion. When we talk about the prices of related commodities, if that related commodity is a complementary commodity, then the price of that complement and the demand for the original commodity have inverse relationship. They have inverse relationship. Whereas in case that a related commodity is a substitute commodity, then the price of that substitute and the demand of the original commodity have direct relationship or positive relationship. This conclusion everybody has to be very thoroughly understanding, and we should apply that also in the problems wherever they are coming. But main point I would like to suggest here is don't try to remember or don't try to by heart them blindly. Understand them logically. Logic will give us answers for any question. If you memorize the things, you will be able to answer only few questions. If you have logic, you can answer any question. So what is the logic here? When the price increases, the quantity demanded decreases. That is quite natural. And vice versa. When price decreases, the quantity demanded increases. But when we are talking about related commodities, we are talking about the price of one commodity and demand of another commodity. Both are not same. So price we are testing on one commodity, demand we are testing on another commodity. So like that, what is the relation between these two we have to understand. For that purpose, we should not directly jump to the conclusion. We should first understand the price of one commodity, what impact it will have on the same commodity first. For example, price of tea increased, demand for tea decreases. This is natural, this is same commodity. Then you go to next level. Okay, if demand for tea decreased, what happens to demand for sugar? That will also decrease. Now you got to draw a conclusion. Okay, the price of the related commodity, which is a complementary commodity, and the demand for the original commodity is inverse in nature. Like that, we can conclude in steps wise process. Directly, if you jump to conclusion, that amounts to just by hearting the theory without understanding why it is coming. Same with substitutes also. Substitutes, tea and coffee we have taken. Say here price of the tea increases. First we have to see what happens to the demand for tea. Demand for tea decreases. When demand for tea decreases, what happens to demand for coffee? That increases, because coffee and tea are substitutes with each other. So once we have understood the impact of the price on the demand of the same product, then we can understand the impact of the price on the other product. That is how stepwise we have to understand how the price of the related commodities will have an impact on the demand of different other commodities, be it substitutes or be it complementary commodities. Very, very important. The crux of this entire chapter, conceptually speaking, is lying in this particular area. Once we understand this conceptually, the remaining things are only expressions and calculations or graphical representations, but concept is all lying here. What is the impact of price of a commodity on the demand, or what is the impact of the price of related commodities on the demand? Very, very crucial thing. Understand this very carefully. And in the next session, we will continue the discussion on how the other factors will have an impact on the demand. So we have discussed about two things. One is price of the commodity. That is one thing. And second thing is price of the related commodities we discussed. Remaining things, income of consumers, tastes and preferences, expectations, those other factors, any other, we will discuss them in the next class. That will be the conclusion of understanding the determinants of demand. But just knowing the determinants of demand is not going to be enough. It has to be coupled with how seriously these will have an impact on demand. What is the intensity of that impact? Of course, all these things we will discuss as part of elasticity of demand. That will come at a later stage. But to start with, today we understood what is the overall I would say, the overview of this entire chapter 2. And within that, there is theory of demand, theory of supply, and theory of consumer behavior. And within that, unit 1, we started with the theory of demand. And what is demand? We try to understand the concept of that, which has to be expressed always as a quantity which is demanded for a particular period of time at a particular price. That has to be always remembered. So definitely quantity demanded will be expressed at a given price and for a period of time. And very important aspect of what are the determinants of the demand. What are the determinants? We understood them on a broader basis, but how they are determining the demand, one by one we start a discussion on that. So first one is the price of the commodity and how it will have an impact on the demand or quantity demanded. It is an inverse relationship. Price of the related commodities, price of the complementary commodity will have what type of relationship with the demand of the original commodity? Once again, inverse relationship. Price of the substitute will have what kind of impact on the demand of the original commodity? That is going to be direct or positive relationships. These are the things that we discussed today, most important aspects in the chapter 2. Once again, I'm repeating, more thorough with the concepts which we are, then it will become easier at the latter stage to expand and understand these concepts and apply them for different other theories also, like the theory of supply or any other places. Wherever we apply, conceptual clarity is very, very important. So read them, understand this concept of demand and determinants of demand very carefully. We'll continue this discussion in the next class. Till that time, take care. Bye bye. Thank you very much.